Welcome to today's web seminar. This web seminar is brought to you by the North Central Region Sustainable Ag Research and Education, or North Central Region SARE. With a grant from them, we're able to host these free of charge. Your presenters today are going to be myself, John Hay from University of Nebraska, and Eric Romick from Ohio State University. And we both teach about energy for the extension services in our state. And we're going to cover today incentives, policy, and electric rate structures. This is going to be a big day today. We've covered some of the basics of design and cost, but really now we're getting into the stuff that's both fun and sometimes complex, which is incentives, policy, and then how we're billed for electricity. And these things are not near as straightforward as they could be. And that's one of the reasons that individual models need to be run to be able to answer that question. Is solar a good deal? It should be more easy than it is, or it feels like it should be. But you'll recognize today what are some of the real complexities of that when we start looking at electrical rate structures and policy in particular. So I want to call your attention to the picture on the right-hand side of the screen. Eric and I do have a bulletin series with a lot of this information in it. So if you are wanting a written record of this web seminar series, you can find it at that bulletin, and you can go to Solar Electric Investment Analysis and type in SARE, and you should be able to link to it. We also might put a link in the chat box for you. If you have questions today, go ahead and type them in the chat, and we will try to respond to them in real time and as we move forward. Today, we're going to start with a discussion of electric rate structure, and then we're going to go into net metering, incentives, and some closing thoughts and discussion. When we think about the electric rate structure, we're thinking about how an individual residence or business is going to be billed for their electrical purchases. And we all wish that, we could just say, well, I'm charged this much for electricity, but that's not the case. It's more complex than that, but also it changes over time. There's an escalation rate or an inflation of that price over time. And that is both caused by the inflation of the economy and then whatever's going on within the industry that may cause that inflation. And I think that the care has to be taken to recognize what is a fair value for inflation to put on those numbers. So those can be either nominal numbers where the escalation rate includes overall inflation, or a real, which actual overall inflation is subtracted. A lot of times we'll use the nominal rate, or that's when we refer to the most, where inflation is included in that. And at times, electrical inflation can be slightly higher than overall inflation, so it's the two added together. What we graphed here was simply a lot of the states that have joined us today on the web seminar, and we have put them on a graph looking at their inflation over the last approximately 20 years. And you can see that there's a large mass of them down here, and so the inflation rate is really kind of the same across most of them. You also have some states that the total price is much higher, like I think that's New York and some of the northeastern states, but the inflation rate is fairly similar. Eric, do you have a comment on that?
Yeah, I was just going to say, I think, one of the things that we've come across, over the years working with farmers, and one of the reasons that I think that this is important is when you're modeling, and again, it's really important that we're comfortable with the numbers we're putting into the model. And so we've seen some instances where, data has been shared with farmers that are considering this, and their energy escalation rates that are nominal in a sense. So it's looking at both energy escalation, but also has inflation baked into it. So the energy rates were not indexed to a specific year. And you could make the case based on what's happening in the markets, what's happening with policy, that yeah, I think we could expect in the next 20 years that this rate of increase for energy cost could increase. But what happens is when you're looking at those charts and you're looking at data and it already includes inflation, and then you make a decision to say double that, and then you have inflation in your model separately, all of a sudden, you've really inflated those numbers. And sometimes, you can kind of almost pick them out if you see a proposal that has some real gaudy, return on investment numbers. It's a good place to start. And so it's just important to understand as you're making those decisions, what numbers you're plugging into the model to make sure that we don't, really over account for inflation.
That's an excellent point. And what we're seeing in this picture here is about a 2%, maybe 2.5% increase over time. But one thing I want to point out is I was visiting with a utility one time, and they told me I should make this number 0. And I said, why? And they said, well, the last 8 years, we have not had an increase in our electrical prices, so it should be 0. And I said, okay, so it's 0. Then it went up 10%. Then it was 0. Then it went up 10%. And so I argued that you can argue what you want, but you have those increases over time to keep up with inflation, and sometimes a little faster. Just because yours is 0 for 10 years doesn't mean that it didn't go up. So I tend to use the average across time. So be careful when you put in those numbers, and be careful that they're not too low, and be careful that they're not too high. But I like to use kind of some of this stuff over time. So you'll see when we start doing it, but about 2.5 to as high as 3 to 3.5% is about as high as we're willing to go. But here's an example of that, where what we have is a escalation rate, and we'll look at the red and the dark gray on this one, where we have a nominal escalation rate of 3.4%. And so you can see the price of electricity increases over time. So if we started today in 2021, we start at maybe 11 cents. And by the time we're done with the project out here somewhere, the price of electricity may be as high as 16, 17 cents a kilowatt hour. That is
John,
very, yes, go ahead, Eric.
Real quick, it's to me, when you look at this chart, it's the price of electricity, but we need to be thinking about it from a project evaluation standpoint of this is revenue. I mean, you're estimating what your earnings will be from this system. So think of it from that perspective as well. Yeah,
that is a good perspective. And I think that's kind of maybe the next thought process, which is that I'm earning more revenue into the future. The value of that revenue, because of that time value of money, may be a little bit less, but I do have increased revenue. But then I have an installer who, for whatever reason, has decided that the political situation in this country is changing, and we're going to see this very large increase in the price of electricity. And so they want to put in a 6% escalation rate. And all of a sudden they're suggesting that, the price of electricity by the end of the project is going to be 40 cents a kilowatt hour, and you're going to make all this money. Well, the reality is not likely that that's going to happen. And part of that is we can look at history and decide that's not going to happen. There are some scenarios where maybe some crazy policy gets put into place, or some policy gets put in place that raises our electrical rates quite a lot. I'm not saying that can't happen, but what I'm suggesting is that if you really are worried about that happening or thinking that could happen, run the scenario with a rate that is more like 2 to 3%, and then run it again at 6%, and recognize that the reality is you're going to fall somewhere in that range. My guess is you're going to fall closer to the bottom of that range, but at least you then know what's kind of a worst case scenario and best case scenario type of a situation. I'm just going to touch quickly on how you are charged for electricity. And I can say this pretty broadly because no matter what the electrical rate structure looks like, it's going to include these 4 elements somewhere in the structure. if it's my electric bill at home in Nebraska, I would say 2 of these, actually 3 of these are hidden. I only have 1 of them on my bill, but they all 4 exist. And I have to call and ask and figure out, but they do exist. One is the fixed charge, what you're going to get charged if you don't use any electricity. This is the charge to interconnect to the grid. This is the charge that helps them cover some of the overhead for their business. It may cover just overhead for billing and kind of some of that, but it also could include, it's increasingly, utilities are increasing their fixed or customer charge to cover some of the maintenance of the distribution lines and some of that stuff. So we are seeing an increase in that fixed charge across most utilities. The energy charge is what you're charged per kilowatt hour for the electricity. And in this case, the energy charge is specifically calling out the energy portion, what it costs to purchase just the electricity itself. Then you have, in addition to that, the distribution and transmission, what it costs to deliver that electricity from wherever it came from to you. And in many residential bills, the energy and distribution transmission are all stuck together into one price point per kilowatt hour. But in more and more bills, they're especially in deregulated marketplaces, those are broken apart and shown separately. And then finally, cost recovery riders, where they have, other adjustments to the bill for different reasons based on the actual cost of fuel and things like that. And those aren't usually very large numbers, but they do influence the price overall. But definitely we see these in all bills once you really get into looking at them. So let's just look at a bill. This is one from out in Ohio that Eric provided for us. And that's good because it's more of a deregulated marketplace. We can more easily see the different sections. But you can see that this person used 800 kilowatt hours in their billing period. They were charged $98.80. You can also see that this is split in half, where they have a supply charge, which is the energy itself, and a delivery charge, which is the distribution and transmission infrastructure to deliver it. So sometimes I laugh a little bit and say this is a little bit like ordering from an online store and the shipping costs more than the product. Well, this is the case. The shipping costs more than the product, but the reality is we want that product, and we're really most concerned about the overall cost of that product, not that the shipping costs more. So let's break that out a little bit. This is the same bill, but in a different section of the paper where it's broken out a little bit. And then here we have the generation or supply section. This is the energy charge, and they're charged $44.24 plus a little bit of a rider. If we divide that out, we're paying 5.5 cents per kilowatt hour for the energy itself. So this is in dollars per kilowatt hour, and my brain thinks in cents per kilowatt hour, so sometimes I just move the decimal place in my head. 5.5 cents per kilowatt hour. The transmission, distribution, and customer charge all total to be 6.6 cents per kilowatt hour. And so we have that it is higher than the generation. And let's go back to that for a second. The thing that's important there is that this is where we have to recognize kind of the view of the utility a little bit, which is that if you're generating electricity on site at your home or your business, and you end up sending some of that onto the grid, why would they pay you for the transmission and distribution? They don't want to do that. They don't want to pay you for distribution and transmission because you didn't really, you should be paying us for that. And so they really only want to pay you for the energy portion of your electricity. And that's the idea that is really critical when it comes to the argument between net metering and against net metering, is this idea that the utility wants to only pay for the energy portion of that electricity because they are providing the transmission and distribution services. Let's just throw out a couple of bills just to give us a little bit of more in-depth complexity of what we see out there. I'm going to start on the upper right hand on small commercial service. So this is a small commercial service where they have a customer charge based on if it's single phase electricity delivered to the place or three phase. Then they have the energy charge broken into distribution and supply. So it's 8.8 cents for the supply and 2.4 cents for distribution. So in this case, they're saying that the delivery costs less than the energy. Well, it could be that this 8.8 cents has some of the transmission in there as well. So, but we told that out, and that's about 11 cents, 11.5 cents a kilowatt hour for electricity, plus my $16 base fee. That's small businesses. It can be that simple. When you start getting to be larger businesses or some maybe more complex ones, they start charging different rates. So that if we move to the lower left, we have a time of day service where I have that same distribution charge, but now I'm charged a different amount for electricity depending on what time of day it is. So during the day, on peak might be 11 a.m. to 6 p.m. I'm charged 16 cents per kilowatt hour versus off peak, outside of those on peak hours, I'm charged 4.2 cents. So it seems like I'm charged a lot more, and I am, but really I'm charged a lot more for only a small portion of the day. And I think that what they're suggesting is that if you can move your load to off peak times, you can take advantage and actually save money using this time of day service rate if that works out for you. And so you're able to choose some of those. As we move into the bigger industries and commercial, and this could be larger farms as well, it kind of changes a little bit. We have a larger customer charge. We have a distribution demand charge and a supply demand charge, and then we have energy charges. But let's just first look at our energy charges. We're at 6.5 cents. 6.5 cents plus 2 cents, so about 8 cents. So 8 cents is less than on the left-hand side, 11, and well, we saw 16 down at the bottom. So a lot of times when you have a larger system, we're going to charge less for the energy side because we're charging for demand to regain some of that other value. Demand is going to be based on, if we can just think about a time curve and think about the use of electricity over time, they're looking at when was your peak use of electricity in kW. So if this is 10 kW, you're going to get charged $15 based on this number, $15 for distribution per month. And if this was 100, you'd be charged $150. And so you are charged based on whatever your peak is, and that's what a demand rate is. And so demand rates don't always work real well together with solar, and so we're going to discuss some of that as we move forward today. But it's important to understand what type of electric rate structure you're on, because it really helps us understand what might be the value of the electricity that we're generating. There's different types of rate structures, and I'm just gonna move through these quick, but flat rates are one price per kilowatt hour. Tiered rates, we have different times of year when those are charged, or different amounts of energy you use, you have different rates. Time of use pricing we touched on, seasonal time of use pricing, real-time pricing, and peak demand pricing. These top four are pretty common. Actually, the only one that I don't see a lot is this real-time pricing, but this is what we heard a lot in the news the other day, so I wanted to touch on it. In a deregulated marketplace, there are customers that can say, I'm going to pay the real-time price, and they're going to pay the price of electricity as it is at that moment, which can be a beautiful thing. If you're on, this is the one I downloaded from yesterday, the real-time price yesterday on the left-hand side was somewhere between maybe 1 cent in the blue to actually 0 cents in the purple, maybe even negative cents in the purple, and as high as about maybe 10 or 15 cents, 20 cents down here. per kilowatt hour. So they're paying some of those high prices, but they're also then taking advantage of the lows. And so they may be paying 0 cents for some of their electricity, which is beautiful. But then if they get a crazy day, like these two maps on the right, these are a couple of those days when it was really cold, if you remember, and the price spikes, they may be paying a price that is extraordinary, and that can be a problem. While the rest of us don't worry about this real-time market, we simply are paying the averages across time. And by paying the averages across time, yes, we are impacted by those extreme days and extreme prices, but not nearly as bad because we're just being averaged with the days like today, which are 1 cent to 0 cents. So what we have in the slide on the far right is that absolutely cool day. Everything was over 60 cents a kilowatt hour and probably was much higher than that. It just peaked, the scale peaks out at 60 cents a kilowatt hour. I heard a number out of Texas that was $9 a kilowatt hour for a short time when they were at the peak of their problem. So kind of crazy business. Let's just touch on these and I'll finish up. This is a simple rate schedule that I downloaded for a small commercial system in Nebraska. And it is 2 periods and 2 tiers. The periods are the time of year. And so I have period 1 is essentially, we'll call it winter. Period 2 is essentially summer. And you can see that the summer prices, this is summer, this is winter. The summer prices are higher because demand for electricity tends to be higher in the summer. The winter prices are lower. And then I have a tier where the first 1,000 kilowatt hours that business uses costs 10 cents in the winter. And then the second, anything after 1,000 kilowatt hours in a billing period is worth 8 cents. So they have this tiered system that kind of gives you some kind of a break for using more electricity. So that same thing happens. So if I generate electricity, I have to think about when am I generating it? Am I generating it in the winter or the summer? My electricity might be worth less in the winter than it is in the summer. Also, then you have the fact of how much did you generate and things like that. So we'll get it. Eric's going to touch on some of that. I wanted to touch on a more complex electrical rate structure. And I actually had to go outside Nebraska because there's not a lot of real complex rate structures in our marketplace in Nebraska because we have a very regulated marketplace. So I got this one out of Minnesota, and it has essentially 4 periods: winter, summer, during the day and at night. So winter during the day, winter at night, summer during the day, summer at night. And I just pointed out 2 things. When is electricity the highest price? It is in the daytime in either the summer, this is summer day, and this is winter day. And so that's when electricity is high price. What are they trying to do? They're trying to, in some ways, incentivize that customer to try to shift load off of that peak time by giving higher prices. Also, they're recognizing that it costs them more to generate at that time, so they're going to charge you more as a customer. So the weekend schedule is more simple because the demands are a little flatter in the weekend, and so because a lot of businesses aren't running, but more complex rate structure. And we're going to need to build these rate structures into our modeling to figure out what is the value of the solar electricity that we're using. A good place to start to find some of these rate structures is go to this database, the Utility Rate OpenEI database. If you just search OpenEI, you'll be able to find it. You can search by your utility, your zip code, and all the different rate structures, residential, commercial, business, and you can look at them. I will tell you that this database for rate structures is quite comprehensive, and it's not always perfect. You want the exact rate structure, you should go to your utility's website and look for rate structures and figure out which one you're being charged on, and that'll give you even more details that you could use. But this is a good place to start. Eric, I'm going to turn it over to you. If there are any questions, please go ahead and ask those in the chat box, and I will either answer them in the chat or ask it, and we'll get them to Eric or I to answer. You're muted, Eric.
Perfect. How's that?
Good.
All right. Good. So, yeah, as John mentioned, we're going to start out by talking about net metering. And, you know, as we reflect back on the title of this module or this workshop, you know, we're really kind of focused on understanding how we're charged for energy and then also understanding incentives. And so, you know, net metering essentially is a type of PV solar incentive. Net metering is essentially a policy-based incentive or agreement between your utility provider and electric consumers that are generating their own electricity with some type of an on-site system, typically renewable energy. So we're going to kind of dive into the details of net metering and try and understand kind of at a high level how it works and what some of the different variations may be, because one of the things that you know we'll kind of point out, and then I think that you'll see as you investigate this a little bit, is there's a lot of variation, not only state to state, but you know even utility to utility. And so it's really important to kind of take the information from this section and then you know go back to your utility if you're interested, whether you can get it off of the website or if you have to call and request it, but get a copy of the net metering rules so that you can really understand how to apply them in your case. Just a couple of high level charts. You know, net metering is the point of these charts is, I mean, this is something that is not unique to a couple of states. As you can see here, you know, over 40 states have some type of net metering policies or mandates in place. You know, you can see, you know, Texas is one that does not. But with that said, you know, within Texas, some utilities have specific net metering programs. So what this is showing is states that have some type of a state mandated net metering program. If you kind of investigate that a little bit further, this is looking at states that not only have net metering, but also have some type of state-based compensation program built in to compensate for net excess generation. So it's kind of another level to net metering, and we're going to kind of explain what we mean by net metering, and then you know what is it that causes net excess generation, and why is it important to understand how we're compensated. And I think a lot of the compensation as it relates to net excess generation under net metering will go back to some of the things that John kind of set the stage with on utility rates, understanding exactly what it is that you're paying for within your utility bill and how it's going to ultimately impact electricity that you might generate from a solar system on your farm. So before we jump into net metering, just a little bit of a history lesson, I guess. You know, prior to net metering, federal law passed in 1978 for the Public Utility Regulatory Policies Act, or PURPA, that basically required utilities to allow renewable generators, or what they refer to as qualifying facilities, to interconnect to the grid. And they required them to allow them to interconnect and then set in place a model or a process for them to be compensated. At a kind of a generic or a high level, essentially what they're requiring through PURPA is that the electric utilities have kind of a standard offer for qualifying interconnected generators that will compensate them. It's what's referred to as avoided cost. Essentially, that is the cost that it would take them to either generate that electricity on their own or procure it from another source. Just a kind of an example from Nebraska, and I think this is from last year, so these numbers may have changed a bit. But you know, where John's sitting, avoided cost would kind of range 3 to 4 cents per kilowatt hour, whereas your retail would be 8 to 12. And so, you know, there's a big difference between avoided cost and retail rate, and that's an important thing to understand. Not only because you know PURPA still exists today, But also, I think as we look at some of the different net metering policies that you may have in your states with certain utilities, you'll still see avoided cost rate as as a piece of the puzzle that kind of comes up sometimes, even with net metering. So it's kind of important to understand when you hear that phrase avoided cost, what are they referring to? Essentially, it's the cost that it takes them to generate that unit of electricity or purchase it or procure it from another source. So one more slide here with a bunch of words, and then we'll get into some more interesting slides with some graphics and pictures. But as mentioned, net metering, it's a policy agreement, or I like to refer to it as an incentive, because it is an incentive between utility provider and the consumer is going to be generating on-site electricity. The term net in this context, we're referring to net kilowatt hours. And so if we think about kilowatt hours in or energy inflows, so what are we bringing in from the utility through the utility grid onto our site? We take that and think about inflows minus outflows, what we would be sending out. Net's going to refer to what's left over at the end of the billing period. And under net metering, essentially what we'll be looking at is whatever's left at the end of that billing period, that net. System owners will be compensated for at least a portion of that. It could be at different levels though, right? So compensation for net excess generation could be at retail rate. It could be at the retail rate of generation only. It could be at avoided cost. And so it's important to understand how we're compensated for that excess generation. And we'll see and look at a couple examples here. So I want to start out by just kind of visualizing as we think about energy inflows, energy outflows, the different ways that electrons are flowing in this system. And I know John shared this image or this graphic last week, but as you can see, we have our load centers. So whether this is a home, farm, or business, and then the main meter here. So initially, the sun's not out, so your solar system's not operating. We have lights on, load source. Oops, we got to back up a second. And you can see there's electrons flowing from the grid to that load source. And so once the sun comes up, all of a sudden your solar kicks on. You no longer need to bring that energy in from the grid because it's going straight from the PV system on site through the meter to the load source. The third option would be there's no load at the home, farm, or business, so the lights are off, fans are off. We're still generating electricity, so that electricity is flowing through the meter back to the grid. So as we go back and think about the definition of net metering and kind of the word net in this context, we'll kind of look at this formula again. So we start with kilowatt hours in. So that'd be kilowatt hours in from the grid. This is grid energy to the load source, minus kilowatt hours out. So that would be any generation that goes from the solar system back to the grid. And the result of that is going to be our net kilowatt hours. And I like to think of this in terms of a month, or I guess a billing period, right? So when we think about net metering, net kilowatt hours, just kind of visualize a billing period. So all of your kilowatt hours in through the billing period, all of your kilowatt hours out through the billing period, what's left over? This value could be both positive or negative. So if it's a positive value, this is going to represent net usage, right? If this is a negative value, this is going to be what we refer to as net excess generation. So you're generating more that month than what you're using. Why is that important? So again, we have energy coming in. Sun comes out, all of a sudden we're generating with our own system. These electrons flowing from our PV solar system to the load center, this is essentially going to offset the full value of a kilowatt hour, right? We're generating a unit of energy and we're using a unit of energy. So essentially what we're doing is we're offsetting a unit that we would have otherwise brought in from the grid and purchased at that full retail rate. So we're offsetting a unit of energy at the full retail rate by generating it and using it. Question becomes, when we have these electrons that are flowing back to the grid, and over the course of the billing period, we have excess generation, what's the value of that net excess generation? John, I don't know if you want to monitor the chat box and just see if anyone has any thoughts, but if you've dealt with net metering in your state, if you've read about your net metering, or maybe you have a system and you've experienced it, I'm just curious what your thoughts are. What's the value of net excess generation? So if you over generate over the course of the billing period, at the end of that billing period, how are you compensated? I'll let John kind of monitor that as we move forward here. So I want to put a couple of real life examples to net metering and to net excess generation. And I want to start with looking at this from a daily perspective. And then we're going to kind of back out a little bit and look at it from a monthly perspective. But initially, we're going to kind of look at November 30th. This is a research site here in Ohio where we have some metering equipment installed, and we're actually monitoring all of the critical motor loads on this farm. This is the load profile for November 30th on a natural ventilated barn, and they have an 11 kW solar system on the rooftop. And so you can see, looking at this 24-hour period on November 30th, the green lines representing their usage, right? So this is their total electric usage on that barn, and it's relatively predictable, right? So pretty consistent. And then you can see in yellow the actual generation profile on that day. And so in this specific instance, all of the units of energy that we generated, we're using, right? We never generated more than what we were using. And so everything that we used, we could essentially say we're offsetting the full value of a unit of energy that we would have otherwise purchased. So if we didn't generate this, everything that's represented in this kind of green box down here, we would have had to purchase from the utility at that full rate. So that's essentially a full retail rate savings in that day. If we were to look at this during July, so now we look at it in a summer month where we're going to be generating more. And again, this is a natural ventilated barn, so there's not a lot of tunnel fans going on here, just some stir fans, feed auger motors, and water well pumps. You can see that it looks a little bit different, right? So our load profile now is falling well below the yellow line, which is our solar generation profile. And a real quick note before I jump into this too far. So, John mentioned demand earlier, and how demand rates don't always line up with solar. This is a good visualization of that. So one might think that, well, if I have on-site generation with solar, I'm going to minimize, or I'm going to eliminate my peak demand charges, because I'm going to generate a lot of energy during the summer when the grid's peaking the most. And that's something that there are certain demand rates in Ohio in the PJM interconnect that's referred to a PJM 5 coincidental rate. And so they'll look at what are the 5 peak hours during the year when the grid was stressed, and what was your contribution during that part. But those are relatively rare. Most of the demand rates that we see on farms in Ohio, they're calculating your demand on a 15-minute rolling window. And so they're looking at what is your peak usage in any 15-minute window during the billing period. And so if you think about how solar is going to impact that, you can see there's still some activity even in July, which is a good a good day for generation. We have activity after our solar kicks off for the day. So pigs are still eating, well pumps still kicking on and off. So while we may offset any demand during the day, it's still kind of these evening hours or early morning hours where we wouldn't be removing a demand, we'd simply be moving it to a different time. So just a little bit of a side note, as John talked about peak demand, I think this is a good illustration that, yeah, solar is going to offset all this demand during the middle of the day, but early in the morning, pigs are eating and drinking before the solar kicks on. Late at night, pigs are eating and drinking, still active before the solar or after I should say the solar kicks off for the day. So let's kind of look at this then as we did before. Everything underneath that green line, so that load profile, this is again going to be energy that we didn't have to purchase from the grid. So we're going to get the full retail rate for that energy that we've offset. However, the interesting part is going to be everything else that we've generated here, because we didn't have a demand for it on site, there's no load need at that farm, we exported back to the grid. And so the question is, what's the value of that energy? And that's where we kind of get to this net excess generation question and how you're compensated. And I think that this goes back to, in a sense, the design questions, as John was talking on our first webinar series. How you design your system is really going to be impacted by a lot of this, because in a sense, as we minimize net excess generation, we'll maximize the financial performance of these projects. And so these are things that we'll need to think about load profile, even in the design phase of a project. So this chart's looking at net metering from a monthly perspective. So think about, kind of how those slides looked on individual days. Well, over the course of the billing period, you're going to look at, how many days did we bring energy in? How many days did we export it? And so the red lines here are representing our total usage for the month. The yellow is representing our solar generation. And then the blue is the net. So the blue is that net difference. This is essentially the amount of kilowatt hours that you'll be paying for at the end of the month. So, you can see January through April, we were still bringing significant amount of kilowatt hours in. And so in a sense, we're just paying that electric bill as we normally would. We're basically getting the full retail rate of everything that we generated these months. Well, we start to have a question then is in May, June, July, you can see we actually have these negative values. And so that's net excess generation. We're generating more, as you can see in yellow here, than what we were using, represented in red. So this net excess generation, the question is, what are we compensated at? On this farm, they were compensated at the retail rate for the generation component of their bill. They actually had a demand rate on this farm that was put in after the solar was established, and so their retail rate was a little bit lower for generation because they have demand built into their rate schedule. And so that's always an interesting dynamic as well. Typically, if you don't have a demand rate, the retail rate for your generation is going to be a little bit higher. So, which would be good for that producer in this example. But they're compensated. So a lot of times you'll hear net metering rules read, any excess generation will be credited to the next month's bill if you have a month-to-month true-up. And so if this is credited to the next month's bill, the question is, how is that credited? Is it credited as a kilowatt hour credit? I can say in Ohio, I'm not aware of any rate structures that allow that to happen. I have seen some in other states. In most instances, that's credited as a monetary credit. And so that's where it gets into understanding, is it the full retail rate for generation? Is it an avoided cost? And that way you can accurately account for the value of that generation in the modeling. And then this would be an example of annual net metering, where they truly do, if you were to roll over any excess generation to the next month as a kilowatt hour credit, you can see how these credits would build over time until you have an increase in load, and then you would essentially use those up. And so it's really important to think about how that net metering rule is applied, and then also to think about what your load profile looks like. And so as an example, if you have month-to-month net metering and you're compensated at avoided cost rate, let's say, for any excess generation at the end of every month, and your main load source is a grain dryer, that's going to be a pretty tough economic case to invest in solar, because most of the year you're going to be generating a lot of energy, and you're going to be compensated at avoided cost rate, which we illustrated earlier is significantly lower than retail. And then in the fall, when you're running your dryer and grain dryer and so forth, you're going to be importing a lot of energy because your system's not going to be large enough to offset the total needs for that site. And so it's important to think about not only how you're compensated through net metering, but also how does your load profile impact that modeling structure. Just kind of a final slide on net metering. You know, typically, it's going to be converted to a monetary credit. That could be full retail rate, generation only, or avoided cost. In rare cases, if you do have a net metering rule where they're allowing you to roll over any excess generation as a kilowatt hour, that's certainly going to be a good policy and something that I think you'll find favorable results as you do the modeling to see how that project will perform from a financial perspective. With that said, even the best model, it's important to recognize that there's a certain amount of risk. Net metering rules change. And so I'm aware of a couple of instances where there were some grain dryers that had annual net metering and say they were allowed to roll over excess generation month to month. And then they were compensated out at the end of the year for any excess generation at avoided cost. That was okay because they could overgenerate all year long. They would really use it in the fall during the harvest season, and there was nothing left at the end of the year. Those rules changed to where it was all of a sudden they're compensated month to month, and it really hurt the financial performance. So just understand that policies are fluid and they're always changing, and so it's important to make sure that you're comfortable with that amount of risk as you're doing this modeling and trying to decide if it's a good investment for your business. This is something that John and I always kind of try and go back to, to maximize the value of a unit of energy that you're generating, simply use it. And so a lot of times we'll model systems and then we'll go back and try and optimize the system design to maximize net present value by minimizing net excess generation. Okay, so we're going to kind of take a pivot now and look at some of the other incentives and some of the other policies that really help put together these projects and things that we need to consider as we're evaluating them. So I want to start with a high level kind of process flow, and I like to think of it as a cash flow mechanics of investing in PV solar. A couple of the benefits of solar, obviously it's an emission-free generation source. The fuel source is free, right? So once we build these systems, the sun shines and we generate electrical current. The challenge with that is it's a significant upfront cost, right? And so we need to think about, we're putting money on the table to buy this system. How are we going to get this money back? And we're going to talk about each of these bubbles here in future slides. But to me, the foundation program, as we think about this, is the Federal Investment Tax Credit Program. It's currently at 26%. For commercial operations, we have depreciation. And then you're going to start to look at what are other incentives, grants, or loans that are available. Some states have renewable energy credits. So renewable energy credits would represent the environmental attributes of generating electricity from a renewable energy source. And there's a certain value in some states based on policy to the fact that you're generating renewable energy. And so how do those apply? Once we get to this point, anything that's left on the table from that initial capital investment it's got to be recovered through ongoing energy savings. And so this is a really important point, and I can't stress it enough. I know that sometimes it can get a little bit tedious looking at net metering and energy inflows, energy outflows, looking at the rate structures that John was talking about and trying to understand the difference between energy generation cost versus distribution cost, transmission cost recoveries, different variable rate structures. But it's important to the best of our ability accurately identify what's the value of a unit of energy that I'm generating and how is it going to be applied through net metering, because we have to be honest with ourselves so that we can accurately evaluate anything that's left over. How many years is it going to take us to get that back? And again, as we work with a lot of farmers, it's it's not our job's not to necessarily sell solar. It's to do a good evaluation. So the question might be, you know, should you invest in solar for your business, or should you invest in another piece of equipment or a different area of your farm operation that would offer a greater return? And so this is a critically important bubble. We're going to start by looking at the federal business energy investment tax credit. So and it's often referred to as kind of the solar ITC. So the solar investment tax credit program, it's a tax credit that can be claimed on your federal corporate income taxes currently at 26% of your eligible construction and equipment cost. And we'll look on the next slide in terms of what are, kind of air quotes here, eligible cost. But I want to first focus on the rate of the investment tax credit program. So this was initially established under the Energy Policy Act of 2005, and for years it was locked in at 30%. And so I think a lot of times people just refer to it as the 30% ITC program. That's changing, and in fact it has changed, right? So it was extended a number of times at 30%. However, in 2019, you see it started to slowly reduce. So it was reduced from 30% to what's locked in currently at 26% investment tax credit through the end of 2022. And then you'll see it drops another 4 points down to 22%. And then ultimately we'll lock in at 10% unless Congress does something different and changes it in the future. But that's kind of the current schedule. And I think it's important to understand that you have a few years now, if you're considering a project, or if you're working with farmers or businesses considering projects, to still kind of jump in at that 26% before it starts to drop down. Just kind of a side note, we tend to focus a lot on farm and business type projects here. And as shown on the chart, they'll be locked in at 10% for future years after 2024. For residential projects, that's not necessarily the same. Unless Congress renews something or changes something, for residential projects, the tax credit will expire in 2024. So they're going to be locked in at 26%, 22%, and then in 2024, for residential projects, that tax credit program will expire altogether.
Eric, I just want to repeat that because there was a question that came in asking if the rate schedule, if the ITC schedule is the same for residential. And essentially, yes, it is exactly the same until you get to the bottom number. If this was a residential system under future years, it would say 0. It means under the current schedule, if you install a solar array at your residence in 2025, your ITC tax credit would be 0. There would not be any tax credit for that installation unless things change. But for businesses, it's going to be extended out 10%. So that's the only difference. Otherwise, they're identical up until the end of 2024. So I just wanted to kind of clarify that. Thanks, Eric.
Great. Thanks, John. A couple of other things on the ITC. The energy property must be operational in the year when the credit's first taken. Of course, that's going to become more important as you get into 2022 to make sure that it will be operational in time to claim it at 26%. And again, this is a dollar for dollar tax credit against your federal income tax liability. And so if you can't use all of that, the entire 26% in 1 year, you could actually do a 1-year look back or carry it forward up to 20 years until you can monetize the entire 26%. Used by businesses subject to federal income taxes. Obviously, it's a dollar for dollar tax credit against your federal income tax liability. So cannot be used by tax exempt entities, which is something that comes up from time to time. In some states, there's a workaround in some states where a tax exempt group, like a school, for example, could indirectly benefit by kind of entering into a third party agreement or arrangement where they would agree to kind of, through a power purchase agreement, purchase the energy for so many years and have a third party that would own it who could utilize that tax benefit and then I forget there's amount of years that they have to hold on to it, John. I'm not sure if you remember. It's either 4 or 6 that after like 4 or 6 years, then that third party could sell the project back to the nonprofit. So just a note that it is a little bit more difficult if it's a nonprofit trying to monetize that investment tax credit program.
That's correct, because you have to have a tax-paying entity. Another comment that came up in the chat that I just want to make sure everybody hears is that the tax credit was extended as part of the December, one of the COVID-19 investment bills, but this slide reflects that change. Originally, it was going to go to 22% in 2021. And so they extended the 26% for 2 additional years. So that's the change that happened as part of that COVID bill in December. And so this slide reflects the new extension.
Thanks, John. Okay, so one more kind of slide on the ITC before we move on. Sometimes I'll get the question, what is eligible property? I've had one farm that was told by a developer that they could build a new building for their combine and tractors and take a tax credit on the building if they put a rooftop system up. It's not quite that simple. So kind of from a basic level, eligible property includes panels, inverters, racking, balance of systems, transformers, disconnects, storage device, as long as the storage device is charged from a renewable energy system. I think 75% of the time is what the requirement is. And then your installations, indirects, sales or use tax on the equipment. So, that's kind of at a foundational level what they're talking about in terms of equipment. It does go on to talk about a portion of, so when you think about eligible property, tangible personal property or tangible property, not including a building or its structural components, but only if the property is used as an integral part of the qualifying advanced energy project. So you have to ask yourself, if you're putting up a huge outbuilding to store tractors and combines, is that an integral part of the solar system? And so it's one of the things that you certainly need to work with your accountants on. If someone's suggesting you could take a tax credit in the entire building, I would really take a second look at this with your accountant before you jump into that. You could see examples where not every solar project's created equal, right? So there's some different projects out there. I mean, for example, you've seen some that may have raised racking, so it's a dual use, right? It's a raised racking system that is also providing shade for livestock. Or another example could be parking. Owens Corning up in Toledo put in a big solar system that kind of doubles as shade for the parking and also keep snow off cars, right? And so there's some dual uses that you could see where they're adding cost to the project because it's a little bit of a unique design component, but not just building a large building and putting solar on top. So, and then you can see there's a link for Form 3468 there as well. Yeah. And that has additional details.
A new building likely could hold the solar probably without a problem, without any additional infrastructure. But if we were thinking, let's say we had an old building and we did some structural stabilization to make sure that it could hold the solar, that additional structure additions to the building could be counted. But like you suggest, the building itself doesn't count, but some of the additional structure to adapt to solar would count.
Right. And I think you can kind of go back to this piece here where it's used as an integral part of the project, right? If you didn't do that additional structural upgrade, and if the structure wasn't able to take the additional load of rooftop solar, yes, that's an integral part of the project. You wouldn't do that if you weren't putting solar in, and I think that's kind of the root of that policy there.
The IRS instructions for residential are less detailed than the IRS instructions for commercial projects. Essentially, the IRS instructions for residential say, how much did you spend on solar? Multiply that by the tax credit rate. It's fairly simple, but again, you don't want to get yourself out and count things that you shouldn't, because if you ever do get audited or have a problem, that could be a problem. But they're fairly simple forms, both in commercial and residential. So from the tax standpoint, really easy to get that tax credit once you've spent the money.
Great. So moving on, look a little bit at depreciation, and again, looking at farm and commercial projects. So the U.S. tax code allows businesses a tax deduction to recover the cost of tangible property that it's invested in. So, generally speaking, depreciation is a coordinated reduction of the cost of a fixed asset over time that's used to offset the revenue that system would otherwise be generating. When we think about PV solar projects, we use the modified accelerated cost recovery system, or MACRS, over a 5-year schedule. One of the things that I want to point out, and sometimes we talk about it on the previous slides with the investment tax credit, is the ITC program, or the investment tax credit program, which is currently at 26%, is tied into or impacts depreciation as we look at PV solar. So for projects that utilize the investment tax credit program, so if you claim that 26% ITC, you need to reduce the depreciable portion of your project by half of the value of the investment tax credit. And so as an example, we have a 26% ITC at the moment. Half of that is 13. So you would take 100 minus 13, 87% of your total project cost would be the depreciable basis for your MACRS on a 5-year schedule. And we're going to look at an example on the next page. So also under the Jobs Tax Cuts and Jobs Act, 100% bonus depreciation is available in year 1 for projects that are set in place before January 1st, 2023. So we still have a little bit of time for 100% bonus depreciation under again, Tax Cut and Jobs Act. And then you can see the schedule below. So once we get past that January 1 of 2023, it drops down to 80%. And then looks like each year it drops down 20% essentially. So I wanted to give an example and try to help you visualize, well, what is the value of depreciation as it relates to these solar projects? And full disclosure, I'm not an accountant, I'm not a CPA, I'm an energy educator. But John and I've worked on a lot of these projects, and we really spend a lot of time in the system advisor model, and we've shared on week 1 how the cash flow tables really get detailed and do these calculations. And you'll see on Thursday, you actually have the ability to export that cash flow table to Excel with formulas, so you can kind of track some of this stuff down. So what I did the other day was I went ahead and ran a simulation in the system advisor model and just tried to look at it from a depreciation standpoint and pull out some numbers so that you can kind of try and wrap your arms around what's the value of depreciation as an incentive. And so we're starting with just kind of a couple of details on what we modeled. So 120 kW system. So this would be a good size project on a farm at $1,850 per kW. So think about our cost discussion last Thursday. That would be $1.85 per DC watt. So our total project cost is $22,000. We use the 26% investment tax credit program. So first thing I want to look at is how we would calculate depreciation. And we're going to look at this both from state level and federal level. And you'll see we have our different years here. We're going to be using, for the state calculations, MACRS model on a 5-year schedule. The first thing that we need to do is calculate our depreciable basis. And as I just discussed, because we're using the 26% investment tax credit program, we need to reduce the total project cost, which is $200,000 $222,000. We have to reduce that by half of the investment tax credit. So we'll take 87% times the total project cost to come up with our depreciable basis of $193,140. So in this example, we just went ahead and ran this assuming a 7% state income tax rate. So you take your 7% times your depreciable basis, and you come up with the state depreciable value of $13,520. Now that's going to be applied using the Maker's model on a 5-year schedule. And you can see kind of the rates here over the years that we're breaking down this 13,520. So, and I guess a point that John made the other day as we were kind of discussing this, this is the value of your state level depreciation from solar. So, if you were to take this on a 5 years Makers, or if I've talked with some that say, hey, I like to be conservative, I'm borrowing money on this project, I want to do a straight line depreciation to match the terms of my loan. And so maybe you do straight line over 10 years. I mean, this is still the value of that depreciable basis for your solar project. So on the federal side, we went ahead and utilized the 100% bonus depreciation in year one. So one thing that was a little bit different here is that to calculate the depreciable basis on the federal side, we take the 87%, right? And again, this 87 is looking at our 26% federal investment tax credit. We have to reduce the depreciable basis by half of that. So 13 minus 100 gives us 87% of the project can be depreciated. So 87 times 100% of the project cost minus the state level savings. And so we look at our year one state savings over here, 2,704. So we have to subtract that as we look at the depreciable basis on the federal side. In this example, we use 21% federal income tax rate. And so you can see as we do the math, $39,992 would be the federal savings. And then I just kind of put a column over here to calculate a sum of both the state and federal. And you can see everything combined would be the value of your depreciation as a incentive is essentially $53,511. I think it helps look at this example for a couple of reasons. I think it helps to visualize, from a monetary standpoint, okay, if you put a 100 kW system or 120 kW system in, what's the value of depreciation? I think it also helps to understand that it's not necessarily instantaneous recovery, right? And this goes back to the idea of as we think about system costs, we need to think about the system cost from a gross system cost, not the net system cost. We're going to write the number on the check for the whole system. These incentives will help recover that over time. Now, obviously, if you can monetize the entire 26% investment tax credit in year one, and you have 100% bonus depreciation in year one, boy, you're doing pretty well right out of the gates, right? So the value of our federal investment tax credit I've calculated up here is $57,720 plus $39,992 through 100% bonus federal depreciation. That's a lot of money that you're recovering in year one of this project analysis. So, it's while these aren't upfront grant programs, which is what a lot of people like to see, they are some pretty effective programs that can really support development for farms and businesses. John, did I miss anything on that? I guess the only other thing I would say before I'll be quiet and see if John has anything to add. There's certainly variables that will influence this. And again, I took some of your tax deductible operating expenses out, which would ultimately influence these numbers a little bit. But you think about your operations and maintenance cost, annual insurance cost, cost of capital, time value of money. Those are all things that are going to influence this as well. So it's just really important that you work with your accountant or your financial advisor as you're going through these scenarios.
I would only add that it's important to remember for those people that are thinking about residential systems that depreciation is not something that you get in that type of system, because this is not a business expense. And so you do get the federal tax credit 26% still, but not the depreciation benefit. So obviously that should be clear to most businesses, but maybe if you're a resident, I just want to make it clear that we're not. That's something that's different between a commercial system and a residential system. So,
thanks, John. And just a kind of couple closing thoughts on depreciation. Just because you can take 100% bonus depreciation in year one doesn't necessarily mean you have to. Doesn't necessarily mean you should. That's where I think it's important to talk with your financial advisor and consider the long-term outlook for the farm. It's important to remember that claiming a full deduction in 1 year means that you give up deductions in future years, and so maybe it makes more sense to spread that out over future years, so that you have deductions against income in future years. You don't want to find yourself in a situation where you've used everything up in year one, and then all of a sudden you get bumped into a higher tax bracket down the road. So it's just important to remember. I think this picture kind of illustrates it. Your solar project is just one piece of your overall farm's tax puzzle or tax plan. And just make sure that you're talking with your financial advisors, your accountants, as you're considering these projects. Okay, so moving on, we'll kind of look at a couple of examples of other incentives and discuss solar renewable energy credits, and then we'll wrap up with some Q&A. So I get a lot of questions about, are there other grants or loans? In Ohio, unfortunately, we don't have a lot of examples, but with that said, it's important to look to see if there's any state level, local government, or in some cases utility companies that may offer grants or support programs for these projects. One of the things I like to make sure I remind folks is that in most cases, your grant funding is going to be considered taxable income, ordinary taxable income. If it's not, then you need to reduce the project cost before you calculate your federal investment tax credit program. So it's just important that we make sure we take that into account in our cash flow table accurately. And then, these programs aren't always guaranteed. A lot of times they're very competitive. So, John, I know you have a program in Nebraska. I don't know if you want to share that at all, or.
Hey, I can real quick, but I think this idea of not guaranteed is important. If it's a competitive grant and the installer is guaranteeing that you're going to get it, that's questionable. We need to make sure that we're able to get that. And if getting that influences you're saying yes or no to the project, you got to wait till you actually get approved for the grant to move forward. So sometimes you got to hold back. If you're moving forward with or without the grant, it's still okay to apply for it, but you may want to go through the proper timing of waiting to buy stuff before you apply for that grant, because it'll help that stuff qualify or not qualify. We're going to cover that just a bit in the next slide. Utilities sometimes do have their own incentives, and it's worth it to ask, but don't be thinking that everyone has it. There's only one utility in Nebraska that has an additional incentive, and that is a capacity-based incentive. If you live in the Lincoln area for Lincoln Electric Systems, they will give $375 per kW of installed solar as a one-time payment based on the kW generation, depending on which direction it's facing. It's $375 if it faces south. It's $475 if it faces west. So they're giving some value if that faces west and provides electricity to them at a time of peak demand, which is in the afternoons in the summertime. And so you can actually model that at different directions and see if that extra incentive is worth it to face it west. In many cases, I've found it's not worth it to face it west. Facing it south and getting the 375 is still better. But think about those incentives and what you're able to get, and we can help you try to model those incentives in the model.
It's interesting that they have different rates based on the direction, but smart from their perspective. Another incentive I just wanted to mention, or kind of have a specific call out for, the USDA Rural Energy for America program, or REAP grant as it's often referred to, is an outstanding program for farms. And it's one of those programs that I absolutely encourage qualifying farms and businesses to apply for. With that said, it's almost like it's such an effective program, and it's very well marketed and administered. It's just become very, very competitive, and it's at least in Ohio. Ohio traditionally uses up all of our state level allocations, and then sometimes we'll look at a secondary round of allocations if other states don't use up all of their funds. But essentially, it's a 25% grant that not to exceed $500,000, which for most projects that we're looking at on farms is not a problem. It also has a loan guarantee portion that could do an additional 75% of the project. You can use the two together. You could have a grant and then also use a loan guarantee for part of the project. I believe the way that that's worded, though, is you would have to have 25% equity in the project if you combine the grant and the loan program together. This is not for residential purposes. And again, it's competitive. I think I've seen some in Ohio where they say, oh, well, we always get it, or we're batting 1,000%, and it's likely to be funded. In most cases, I think like 30 to 33% of the applications get funded in Ohio, just because there's so many projects that are submitting applications. And so at that rate, if it has to go in a bucket that says likely or unlikely, it's unlikely to be funded just because it's competitive. All right, so finally, I want to wrap up with solar renewable energy credits, or what's referred to as an SREC. A solar renewable energy credit is representing the environmental attribute of solar electric generation. So it's important when we're thinking about SRECs, it's totally separate from the actual energy generation. So an SREC doesn't influence net metering. It doesn't influence where that electron flows. It's simply a policy generated tool that is saying, we think that there's additional value to this unit of energy because it was generated by an emission-free resource. So the one way that an SREC is tied to actual generation is that an SREC is equal to 1 megawatt hour of production. And so 1,000 kilowatt hours of generation, I guess you could say. So for every 1,000 kilowatt hours of generation from a system that you would own, you would have this SREC that's generated. And as the owner of the system, you would be the owner of that SREC, and you have the ability to try and monetize that in a couple of different ways. So SRECs are tools that others that are mandated by policy can purchase to help satisfy part of that requirement. So as an example, if there's a state level renewable energy policy that says our investor-owned utilities in the state need to diversify and generate a certain percentage of their electrical generation from renewable resources, they could either go build and own and operate a solar system, and then they would have those renewable energy credits to satisfy that policy mandate. Or in some instances, they could go out and purchase renewable energy credits from other projects. And so what that does is, it provides cash infusion into other projects to be built, and at the same time satisfies their policy needs to meet some of those mandates. So there's a number of different ways that these renewable energy credits can be structured. I've seen some where there's kind of a group of aggregators that's evolved that will kind of manage these, and so you can lock in with aggregators to sell your SRECs at a upfront cost for a certain defined period of time. Maybe you lock them in at a certain price for 5 years or 10 years or 15 years. And then when the period's over, you get the ability to go to the table and renegotiate. I've seen some that will manage them in real time for a certain percentage fee. So, they'll monetize them as you generate them based on current market conditions, and they just keep a percentage for managing the sale of that SREC. I've seen some developers that will actually purchase SRECs up front, and so they'll give you upfront cash, purchase SRECs, and then they'll go ahead and play the markets to sell those. One thing to keep in mind, I did see a couple of examples back in like 2012 to 2014, where there were some farms that were looking at proposals of, and they were looking at $40,000 to $50,000 up front to, they would receive upfront cash for the sale of their SRECs. Kind of there is this point that we need to consider in terms of taxable income. So there is an IRS private letter ruling that did deem the upfront sale of SRECs as a taxable transaction. So just kind of keep that in mind as we think about our cash flow table. So what's the value of an SREC? Here's a table that kind of shows the weighted average over time here and the PJM interconnect. And again, there's highs and lows. This is kind of the weighted average because, as I mentioned, some people are locking in prices over long periods of time. You can see, obviously, there's kind of a consistent downward trend that we're seeing. New Jersey is the one that's kind of sticking up here in blue. They're still just right at $200 per SREC. I actually went on one of the aggregator websites and was just kind of checking or spot checking prices. They do latest price offering, per day. I noticed that Ohio was trading at $9.50 per SREC, compared to New Jersey, which their latest offering today was at $233. And so, it's important to recognize that, SRECs are kind of unique. They're influenced by a number of factors. Obviously, they're going to be impacted by supply and demand. So policy is going to impact that. They're going to be impacted by what's the penalty for non-compliance, right? So I'm mandated as a utility by policy to generate renewable energy. Well, what's the penalty if I don't? That's going to kind of set the ceiling for SRECs in many cases. So I went real quickly this morning, just pulled up New Jersey's policy to see, why they're trading so high right now. And, one of the things, just a quick comparison, Ohio to New Jersey, right? Ohio's renewable portfolio standards were locked in at 12.5% by the year 2025. Then they were reduced to 8.5%. There's some ongoing stuff here where it looks like that's going to go back to 12.5%. It's been somewhat of a moving target in Ohio, but rather low compared to some other states that have more aggressive policies. New Jersey, in comparison, has increased their renewable portfolio requirements to 35% by the year 2025 and 50% by the year 2030. And in addition, their non-compliance penalty for not meeting that mandate was $268. And so, you can kind of see why, again, some of the values in different states, it's based off of the renewable portfolio standards and kind of, how are those structured in terms of how aggressive are the mandates? Is there a specific solar carve out? And what's the non-compliance penalty? The other thing that I'll say will influence this is what markets you can sell into. So as an example, Ohio allows neighboring states, so states that adjoin Ohio, can register their solar projects to sell SRECs into the Ohio market. And again, this goes back to supply and demand. So that increases the supply of SRECs in Ohio. By comparison, Ohio can't sell into the New Jersey market. And so, they're kind of limiting the supply, which, I guess there's a debate as to whether that's good policy or not. And I think that there's probably sound arguments on both sides of that. But regardless, that's why we see a variation in the value of those SRECs. In summary, as we think about policies, despite the rapidly declining costs that we looked at last Thursday for PV solar, incentives are still really important to the overall economics or cost effectiveness of a project. Just kind of three different scenarios looking at incentives. And again, I use the standard financial metrics that we discussed last week. These are kind of the foundation pieces that the system advisor uses to evaluate these projects. our first example is kind of a best case scenario. So 26% investment tax credit. We received, we'll say we received the 25% REAP grant. We had 100% bonus depreciation, and I think we accounted for $25 per SREC on the SRECs. And you can see, a very positive net present value, 5.6 year simple payback period, and a 7.2 discounted payback period. I believe I used a 6% discount rate on that, but the time value of money, I used the same for all three scenarios. So it's apples to apples comparison. In the second scenario, the only thing that we did was we just used the investment tax credit. So, okay, we have the 26% ITC. We didn't receive the grant. We didn't do bonus depreciation, and we did not use SRECs. All of a sudden, we have a very negative net present value, a 16-year simple payback. And this NAN is essentially meaning that our discounted payback period is longer than the project analysis period. So it's a 25-year analysis period. Our discounted payback's longer than 25 years. And then, of course, if we look at that on a worst case scenario, if we don't have the investment tax credit program or the grants or depreciation or SRECs, if we're simply looking at it from a net metering standpoint, again, 21-year simple payback, negative net present value. This is where you're going to want to invest your money elsewhere in your business where you can get a greater return. So the takeaway with this is, yes, the cost of solar has been coming down, but with that said, investments in these projects are still very much dependent on incentive programs. And then the last thing I'd like to just, again, remind you is that incentives don't have to take the form of a grant. And I think sometimes there's this misunderstanding that, well, where are the solar grants at? Well, it's not always a grant. It's the investment tax credit program. It's bonus depreciation. It's net metering. Those are also incentive programs that are encouraging this type of development. So finally, a resource if you're interested in looking at what's available in your state, I really encourage you to look at the database of state incentives for renewables and efficiencies that's operated through the North Carolina State University's Clean Energy Program. They just do an outstanding job. You can filter it by state, by technology type, by incentive type, by sector, whether it's residential, commercial, agriculture. Just all kinds of opportunities to really try and drill down and figure out what programs would fit for your situation. So a great resource to kind of take home with you. And then with that, I will turn it over to John to kind of facilitate questions and the wrap up.
Eric, let's just go to the next slide here and do it that way since this is the timeline. With all that we talked about today, it's a little overwhelming, but we're going to help you apply that using the System Advisor model next week. And I think the System Advisor model is going to play two roles. One, it's a tool that you can use to model your own systems. But even if you don't model those systems, by applying the model, we're going to be able to help you to understand that how these kind of details are applied. And then when you see have customers maybe or clients that are helping are getting quotes from installers, you'll be helped to interpret those quotes and see, are they applying these details? Some of these details are really critical to apply, others are less critical. And you'll also be able to recognize, okay, if we're doing a simple economic analysis and applying one rate for the electricity for all the electricity, we have to take that with a little bit of a grain of salt, because we recognize that the value of electricity might be different during different times of year. And if we need to apply those rates correctly to get a real good detailed economic analysis. So with all that said, what I recommend is that you download the System Advisor model and give it a try for yourself, and let us help you troubleshoot that model to run your own systems and run some scenarios in your locations. And we will help you next on Thursday, either during the session if there's time, or we'll have that working session in the afternoon to work through those. To download the System Advisor model, you simply go to this website or search System Advisor Model and NREL. You'll find it. You can download it for Windows. You can download it for Mac. If you download it for Mac, you might have to make sure you give the Mac permission to run it. So you have to go into your system permission settings sometimes on Mac to download it. I've had some students have that issue recently, but they were able to get around it by changing the security settings within their Mac. This is from the National Lab. They're going to ask you to register it. That registering it is simply putting in your email address so that they can track how many times it's used, and they do that, and they'll tell you why they do it, but they do it so that they can apply to the government for funding to keep it updated. So you can run it 20 times without registering it. So if that's kind of the way you want to do it, you can actually get a little bit of experience, but I recommend you downloading the System Advisor Model.
John, just a side note, I think our slides fell victim to autocorrect on the website for that Desire page. So I just posted in the chat box the desireusa.org URL. So anyone that's interested in going to the database for state renewable incentives, that's posted in the chat box. So I apologize for that error on the slide.
They did. It is desireusa.org, not DSIRE. Yeah.
Well, and I look at the slide, it actually auto-corrected desire to the word.
Oh, that's a problem too. So it's DSIRE USA.org, and we'll get you that. Again, if you have any questions, we're going to be on for a minute, but otherwise we're done for today. And thank you very much.
Thanks, everyone.